So what you'll see here in this example is the 60-minute and daily groups negated the weekly group, as the weekly price was higher than it had opened. And this occurred from a 2 up, 2 down daily reversal, and then was reconfirmed during that daily reversal by an inside 60, which triggered as a measured move. So what you'll see. In this video, we will explain time frame continuity. It will be a 2-part series, so stick around. In the first part, we will cover 1 through 6, which will be the time frame participation groups, universal truth of the opening price, the 4 C's of continuity, the importance of uncoupling, event continuity, so how news pertains to our continuity levels, and then combining actionable signals with time frame continuity. And we will expand on that in the next video alongside identifying natural buyers and sellers, and then live charts with some examples of this occurring. The 4 major time frame participation groups. These groups represent how we quantify full time frame continuity. Because of the importance of these 4 groups, when analyzing any futures, ETFs, stocks, or currencies, we always look at least 4 charts. The monthly group. This group is defined by anyone who has put on, added to, or reduced a position during the calendar month. The monthly chart draws 1 bar to represent the entire month. And the distinction there is you need to know that the monthly chart is its own group. It's not just 20 daily charts put together. It is its own bar, and it's 1 bar until the end of the month, and then it closes. Then we have the weekly group. It is defined by anyone that has put on, added to, or reduced a position during the week. The weekly chart draws 1 bar for each week. Then the daily group is defined by anyone that has put on, added to, or reduced position during the day, and the daily chart draws 1 bar for each day. Hopefully it's simple and repetitive. And then the last one, the 60 group, is defined by anyone that has put on, added to, or reduced a position during the 60-minute period at the bottom of each hour. The 60-minute chart draws 1 bar for each hour. And then the final groups, or intraday groups, can then be used or applied to intraday trading. So you can use these following groups in your analysis if you're a day trader. You have the 5-minute or 5er group, the 15-minute or 15er group, the 30-minute or 30 group, and the 60-minute or 60 group. These become more important as volatility increases. So when periods of high volatility are among us, we then look to go trade the intraday groups because you might have the 5er making moves that the 60 normally makes. So it makes sense to just go trade that 5er because you can trade every 5 minutes then and get moves you'd normally get on a 60-minute chart. The universal truth of the opening price. Bullish time frame continuity, we also call full time frame continuity up. This condition is defined as the last sale being higher than the opening price of the monthly, weekly, daily, and 60-minute time frames. And you will see we're trading above the open across all 4 major time frames here. Bullish full time frame continuity. We also have bearish full time frame continuity, also known as FTFC down. This condition is defined as the last sale being lower than the opening of the month, week, day, and 60-minute time frames. You'll see inside down month, and then red week, red day, red hour. Anytime this is red, they're all selling. So what this tells us is the level of aggression of buyers or sellers is high. And this cannot be disputed because all known participants are buyers or sellers during full time frame continuity. Thus, it is a universal truth of price action. It is also important because it represents when all participation groups are confirming each other and are in control. Continuity in conflict. Anytime 1 or 2 candles are a different color than the others, the price is considered to be in conflict. In this case, the month is green, the week is green, the day is red, and the 60 is green. So we would say the day is in conflict with the week, month, and 60-minute time frames. Although we are always aware of the major time frame continuity levels, we are also aware of the lower time frames as well. We define the intraday continuity levels as the 60, 30, 15, and 5-minute time frames. During periods of extreme volatility, we can use the 5-minute, 3-minute, and 1-minute as well. Sometimes you can even go sub 1 minute, but that's not everybody. Not everyone's cut out for that. The 4 C's of continuity. The first C is control. Ask yourself, which participation group or groups are in control of the current direction of price? The second C is confirm. Ask yourself, are all participation groups confirming each other? The third C is conflict. Ask yourself, are participation groups in conflict with each other? And then the last one is change. Are the participation group or groups changing the continuity of the other groups? At all times, we need to establish which participation groups are in control and for how long. The monthly group is the largest and thus represents the institutional group. The daily group represents who's in control today. The 60-minute group represents who's in control right now, as it's the most immediate direction of price. When the 60 and daily groups are confirming each other, they override the week and month group for control. This makes the flip important, as it will either continue to confirm the daily for control, or change control back to the 60-minute, week, and month groups, should those three be in the same direction. Any other combination would leave only the 60-minute in control, as the others are too conflicted. And what that means is, let's say the week, month, and day are all red and the 60 goes green. You are very conflicted because this is the only thing in control. It's the only thing going up at that point. The weekly group then will either reconfirm or negate the monthly group, and is reconfirmed or negated by the day and 60-minute groups throughout the week. So once we've determined direction for the month, the new week will begin and either confirm or negate that monthly group by going into conflict. So what you'll see here in this example is the 60-minute and daily groups negated the weekly group, as the weekly price was higher than it had opened. And this occurred from a 2 up, 2 down daily reversal, and then was reconfirmed during that daily reversal by an inside 60, which triggered as a measured move. So what you'll see is at this point, when this daily reversal occurred, the month was red. And we know that because the month opened right here. So we were below that. When that daily reversal occurred, the week was at that point 2 up and green. It was not in force, but it was 2 up and it was green. And we know that because the week open was right here in reference to the daily time frame. So this daily 2-2 reversal went in force off an outside 60 right off the open. Then you'll see the idea of the measured move. This day reversal is in force all day, and the next target's down here. So what we look for is this inside 60 to trigger as a measured move to reach that daily target right there. And you'll see that's what happens. They trigger as a measured move. They did about 90-ish% of this morning move here right off that inside bar. And that's an example of reconfirming what we know about that higher time frame and negating the week. You can see that occurred the day after, where we had continuation and our short entry here actually didn't get touched, so we could hold on to that, and we did. Now, the importance of uncoupling. Uncoupling is the first time during any month where the opening price of the 4 major time frames will occur at different times. On a Monday, the daily and weekly opening prices are the same. So those prices, they're the exact same price. They opened at the same time. During the first hour on Tuesday, the opening prices of the 60 and daily group are also the same. Thus, the earliest an uncoupling can occur is the second hour of trading on a Tuesday. This does not mean we do not trade until Tuesday. It means that we gain more quantitative evidence in which to gauge the probability of our trades based on the separation of the participation groups. If the last day of the month is between a Friday and Sunday, aka on the weekends, uncoupling does not occur until the second hour of trading on the following Tuesday. So since the month and week open on that same Monday, they would have the same opens, and that doesn't change until the second week of the month. Yet if the month ends on any other day, the uncoupling occurs during the second hour of the day following that monthly open. So if the monthly open were to occur on like a Wednesday, on Thursday, you would have uncoupling because at that point, the week open didn't change from Monday. The month open did change, and the day is no longer coupled to the month. So you'd have all those 4 major time frames. Every Monday, 3 time frames begin. The daily and weekly continuity remain the same all day because they both open right at the open on Monday, and only uncouple from the 60-minute during the second hour of trading when the first 60 time frame exhausts. Every day, 2 of the 4 major time frame continuity prices are established, the day and 60-minute. Thus, uncoupling on any given day cannot occur until the second hour of trading. Events that occur during the trading day also form an important continuity level. An event can either be a known event or an unknown event. Examples of known events would be weekly oil inventory numbers, Fed minutes, FOMC, CPI, PPI. Those occur before the open, so more relevant to you futures traders, job claims, elections, etc. Unknown events are unscheduled news events that occur during the trading day. The continuity level for these events is the price at the time that the news event occurs, and that remains for the rest of the trading day. The reason this becomes a continuity level is because it changes the perception of the participation groups, as well as their levels of aggression of buying or selling. And what that means is if you have something full time from continuity, let's say a stock were to just randomly release their earnings report on like a Wednesday at 8 or 9:30 in the morning, so an hour after the open. At that point, anyone that was trading before had no clue of that information, but now the information's out, so if it's bad, they're potentially done buying, they'd start selling, or maybe it's really good and they start buying more aggressively and confirm what you know to be true, which is what we normally look for. Combining actionable signals with time frame continuity. As we continue to put the three universal truths together, which to side note, what are those? Those are going to be your 1s, 2s, and 3s, which include your rev strats and inside bars, but also include your 3-2 reversals. They include your continuations, 2-2 reversals, the Randy Jackson, etc. So that's one universal truth. Then the second is your time frame continuity. And the third is your price discovery broadening formation, which we get from the first universal truth that includes the 3. So as we continue to put these together, we increase our evidence to help our determination go from possible outcomes to probable outcomes. Meaning, from possible, it could go up, it could go down, it could go nowhere, to probable, where it's highly likely to go up or it's highly likely to go down. In previous episodes, we learned the flip occurs as the 60-minute bar closes and a new one opens, as well as being the only major time frame that can form and trigger an actionable signal in the same trading day. From a time frame continuity perspective, the importance of the flip is that it determines control. As the most immediate time frame, the direction that the 60-minute bar goes from the flip is the time frame that is in control. It also determines whether all time frames are confirming or they are in conflict. When we combine this with the potential of an actionable signal triggering after the flip, the potential of change occurs, as a new actionable signal changes the known conditions of price. Because the actionable signal on the flip can trigger on the same day, that signal then confirms actionable signals that are in force, thus creating a combination. This negates any other actionable signals that are putting the continuity in conflict. For example, the weak hammer is in force. The day is 2 up, 2 down reversal. And then a 60-minute hammer signal forms and then goes in force. That would put the weak hammer back in control, so long as the weak hammer is still in force. And that would negate the 2 up, 2 down signal, so long as the 60 group continues to buy. Although the flip is important from a new major signal and continuity level standpoint, we want to define price conditions across all major timeframes using actionable signals and timeframe continuity. We have no opinions and only speak in description of what we know to be true. We want to evaluate what conditions will be created if actionable signals are successful or if those signals fail. Also, how they will confirm, conflict, or change timeframe continuity. And this is a great comparison by Rob. He says this is akin to playing billiards. So if you only focus on hitting one ball in without evaluating the effect on your next move, you aren't a very good pool player. Good pool players take shots that will leave them another shot and so on. This is true for us as well and helps us decide which actionable signals we want to take. If this works, what will it set up, trigger, or confirm? If this fails, what will that set up, trigger, or confirm? So I said we wouldn't do charts, but I want to give you guys a couple because we've been talking about the RevStrat stuff on the indexes. We'll keep talking about it. So index, we'll go to IWM. This is the weakest one. And we know that because the RevStrat quarter has gone in force. So we are countering that known equilibrium. Anyone that bought up there, they're being forced to sell with stops here and here. So we're looking for that RevStrat magnitude, 167.46. And then if they're weak, they'll continue to 162.5. And that's because the month is still red. That doesn't change for another 15 days. So as long as that's red, we want to be sellers, right? And if we go now to the week, that's going to reconfirm that with a shooter, Randy Jackson, 222 week. So under 169.69, we would like to be shorting. And ideal target, 162.5. And what that would do, take us from being stuck inside year to then 2 trending year to the downside back to 95.69. So this is a super important thing to know about in the markets. And if we go to SPY, this would be the second weakest I can find. You're going to see the week, potential 222 Randy Jackson as well, shooter counter hammer. Quarter would be reconfirming back under 422.29 with the weekly magnitude being 420.18. So if this works, we will redo that quarter trigger. And then under that 422.29 level, we look for 403.74. So we're starting to see stuff kind of set up where if you bought the market last week, then you're going to have to start getting out. So we want to be the first ones to throw the punch and make those guys sell out of those longs. And we'll see if that can happen. Needs to get under 42.701. And what we'll see then is the QQQ, also shooter week, still inside quarter. So we would like to see that one go 2 down. Shooter week would have 7 days to do it. Magnitude gets you a lot closer there. So about $7 a range there. And we'll see. It's still inside month at this point. So don't get your hopes too high, trading the Qs. IWM, nice and red. We'd prefer that one. And then within IWM, we see chips all being weak with SMCI right here. So SMCI, the reason that one's more important, in my opinion, is because it's part of IWM. So if IWM starts getting killed, this one could go all the way back down to here, 228.26. And what that would do, quarter's inside, so not in control. Month went 2-2 reversal, but under this, it's a nothing because that's no longer enforced. So it doesn't matter as far as we're concerned. It's 2 up, but it could negate because the weekly magnitude would then flip that month from green to red. So anyone that bought in this, you got to get out. And back to 228.26 you'd go. So definitely good to know about that with the IWM. And I'm not going to give you guys everything because the market's huge, but that's a good place to start. So I'll see you guys hopefully in the next time frame continuity video. And if you're enjoying it so far, please like the video and share it. That'd be awesome. And if you do have any comments or questions, feel free to leave those in the description. And I hope to see you guys in the next one.